the case. Well, like Emilios, it's not just cash, I miss checks as a kind of more modern version of bills of exchange, being a form of private money invented to serve the needs of commerce. Maybe that's the way of the world. But it is my very, very great pleasure indeed to welcome Professor Lastra, who has an exceptionally distinguished academic record. She is the professor, the Sir John Lubbock Chair in Banking Law, and also a variety of other positions. She's chair of the Institute of Banking and Finance Law at the Center for Commercial Law Studies at Queen Mary University. She's a member of the Monetary Committee of the International Law Association and has a number of other associations equally laudable and of great stature. She has an international reach as well. Before she came to London, she had been an assistant professor of international banking at Columbia University in New York, in the US. She had also, before that, been a consultant to the International Monetary Fund in Washington, and also a visiting professor for a number of years in Stockholm. In addition, of course, she has had her degrees in Spain at, I won't pronounce this correctly, but Valladolid, where she took her degree, Madrid University, the London School of Economics and Political Science, and I think also a Fulbright scholar at Harvard. So collecting a number of degrees up to a PhD amongst all of those. So she is exceptionally well qualified, not least I'm excited because it's rare to have a book by one of our speakers and so loved that you can see a much used book. The volume dates now from 2010 and it's Cross-Border Banking Insolvency. So not only was her stature there to edit, but she also had the substance to contribute. I think it was chapter 7 on cross-border issues. Her more recent developments and topics are central bank digital currencies. And so without further ado, I now give you Professor Lastra. Thank you.
Thank you very much for this kind introduction. Thank you very much, Emilios. This is really a wonderful opportunity for me to be with you all and with your students. So good evening to everyone that has just joined in. And I would like again to express my sincere thanks to my good friend and dear colleague, Professor Emilios Avgoleas, for inviting me to deliver this distinguished FinTech lecture. And I would also like to congratulate Emilios on the award of a Leverhulme Research Fellowship on a subject which is related to FinTech, which is a new social contract for finance on decentralized finance. My gratitude extends also to Parker Hood and the University of Edinburgh, and of course to Lady Wolffe for her very kind words and for chairing this event. My presentation today on central bank digital currencies and the case for public money is divided into 3 broad parts. In the first part, I will talk about when, how, and why digitalization reached the source of central banking, and how traditional legal categories, such as legal tender, are adapting to the digital space. I will then consider how the trichotomy of cryptocurrencies, stable coins, and CBDCs is challenging established notions of money and monetary sovereignty, and how also the old debate between a state theory of money and societal or market theory of money is being revived with the arrival of virtual currencies. Finally, I will offer some reflections on the international aspect. Do we need an international digital currency, for example? And I will also briefly discuss the monetary system or some aspects of the monetary system after the war in Ukraine. The main thrust of my lecture is that money is a public good. At the national level, this justifies the public ordering of the monetary and the payment system via supervision and regulation. And at the international level, it will require, in my opinion, some degree of international regulation. After all, global money is a global public good. Let me start first on how, why, and to what stage digitalization has reached the source of central banking. The development of digital currencies, of which Bitcoin, as we know, was the pioneer, is a real game changer in monetary law, as Emilio's kindly mentioned in his very kind introduction. Private sector innovation in this area is pacing ahead at great speed. Digitalization has changed already payments for some time and is now also changing money. The entry also big tech, Google, Microsoft, Amazon, Apple, Facebook, Meta Facebook into the financial arena, competing with traditional banks in the provision of payment and other financial services, is a further manifestation of how the digital age is profoundly reshaping money and finance. The advent of distributed ledger technology, DLT, shadow payments in China and many other jurisdictions, and other innovations have transformed what was once a finite territory of money into an increasingly diverse and fluid domain with very porous borders. Inherited legal categories and also the regulations that adopt them, or being applied sometimes with limited guidance from the literature, and of course the judicial increasingly is looking into these matters. But indeed the legal framework of money and central banking around the world was drafted well before the digital revolution. For instance, central bank laws speak about coins, banknotes, central bank reserves, but they do not speak about digital currencies, tokens, or ledger systems. I have actually co-authored a paper with Jason Allen that we entitled Lex Criptographia Financiera, looking at some of these new terminologies that are trying to come to terms with the reality of the digital space. Central banks at the beginning were skeptical of virtual currencies, but this all changed when Libra, which then became Diem and was ultimately discarded at the beginning of 2022 by Facebook, arrived. Central banks had watched the arrival of Bitcoin as a niche experiment for exoteric libertarian aficionados, I like to say. And in California, sometimes even people engaged in money laundering around the world. In a war, they had watched the advent of virtual currencies, not with a great deal of sympathy, but actually, to be honest, not with a great deal of concern either. They did not feel threatened. However, the announcement by Meta, Facebook now, Facebook then, with its 2.9+ billion users of a digital currency was a turning point. Central banks, which were reluctantly dragged into the digital provision of money, now actually may experience some form of FOMO. Emilius was referring to his young daughter. I will be referring to some of my teenagers, the fear of missing out, FOMO, which is one of the traits associated with the constant use of social media. So those central banks do not want to let the system of fiat money, independent central banks pursuing a monetary policy based on the reserves of the banking system and financial stability derail because of the advent and the development of private virtual currencies and shadow payments. They are aware that digitalization has indeed reached the source of central banking. China and Sweden, two different jurisdictions, went first with their proposals, and they are both at an advanced stage of development with the Chinese digital currency electronic payment, DCEP model, as well as the Chinese digital currency and the Swedish Riksbank's e-krona. Central bank digital currencies have in a very short period of time become mainstream. Emilius was referring before to the Atlantic Council, and it is reported that around 90 countries are exploring the introduction of CBDCs, and that there have been already successful launches, including some, I would say, fringe jurisdictions, Bahamas, Sand Dollar, Nigeria's e-Naira, Marshall Islands sovereign coin, the Lithuanian LB coin, and Cambodian Bangong. And other major countries are at an advanced stage, including South Korea. The ECB, let me just briefly talk about some of the key central banks in our close to our source, the UK with the Bank of England, the ECB, and the US Federal Reserve System. The ECB published in October 2020 a report on the digital euro. And in July 2021, the ECB announced a 24-month investigation phase for the digital euro project, which will explore the potential of both a retail and wholesale CBDC. I will explain a little bit later in my lecture these two concepts of retail and wholesale CBDC. In the UK, as Emilios was also mentioning, the Bank of England and Her Majesty Treasury announced the creation of a task force in 2021 to explore CBDCs. And it is true that the House of Lords Economic Affairs Committee has recently published in January 22 a rather skeptical report on CBDCs entitled CBDCs, a solution in search of a problem, ? But notwithstanding this skepticism, on 4th April 2022, earlier this week, the UK government announced plans that will recognize stablecoins, again I will define them shortly, as a valid form of payment as part of a wider agenda to make Great Britain, a global hub for crypto asset technology and investment. In the US, in early this year, the Fed, the Federal Reserve System, which I must say has been a reluctant latecomer when it comes to CBDCs, also published a report on the US dollar in the digital age. And US President Biden signed an executive order on the 9th of March 2022, all very recent developments, requiring the government to assess the risks and benefits of creating a central bank digital dollar, as well as studying other cryptocurrency issues. So these developments point to the increasing pressure from politicians to regulatory agencies and central banks to modernize the financial regulatory framework and make it fit for the digital and decentralized finance age. The question with so many proposals, is this a race to the top or a race to the bottom? What are the motivations, the advantages and drawbacks of this seemingly unstoppable process? And what are the main design features that central banks are considering? Let us start with the motivations. As the 2022 House of Lords report on CBDC summarizes, in developed countries, there are two common motivations. First, central banks are concerned that big tech companies, such as Meta, Facebook, could issue their own digital currencies to the users of their vast networks. There was actually another announcement in the FT today, enabling them to accrue excessive market power. And secondly, many central banks are concerned by the decline in the use of physical cash, lamented both by Lady Wolffe and Emilios at the beginning of the presentation. This decline actually predated the pandemic, certainly in countries such as Sweden, but it has accelerated in the context of the COVID-19 crisis. Most payments that were made in cash are now made via debit and credit cards, and these technological changes are just going ahead. In developing countries, I have to say there are other motivations, including financial inclusion, remittances, which have been very expensive in the past, and a desire to diminish the reliance on the US dollar and dollar reserves. In January 2021, the general manager of the BIS, Agustin Carstens, asserted that if digital currencies are needed, then central banks should be the issuers of those currencies. But at the same time, he cautioned that the development of CBDCs comes with a host of technological, legal, and economic issues that warrant careful examination before issuance. Central banks, he said, are the guardians of stability and have to proceed carefully, methodically, and in line with their mandates. I have absolutely no problems with in line with their mandates, though sometimes that might imply that the mandates need to be adjusted. But what about careful and methodical? I don't think that the process so far has been either careful nor methodical. What about the legal mandates? The limits or contours of the legal concept of money delineate the regulatory perimeters. For example, in 2018, I was asked to write a report for the European Parliament on virtual currencies. And at that time, the then president of the European Central Bank, Mario Draghi, stated his position on the classification of virtual currencies. This came after the Estonian government had come with a proposal on the Estonian Central Bank for a CBDC, the S-coin. And then it was deemed that that proposal, that new form of money, would be inconsistent with the treaty, in particular Article 128 of the Treaty on the Functioning of the European Union, which grants the monopoly of note issue to the ECB and the NCBs, and the euro is the only currency in the Eurozone. And so what happened then is that privately issued virtual currencies, such as Bitcoin and others, were dismissed as money candidates, and therefore they were held to fall outside the oversight remit of the ECB. In consequence, what happened is that regulation occurred at the national level in all sorts of jurisdiction, from Malta to France, leading to a proliferation of rules that actually may create the conditions for undesirable regulatory arbitrage. Now the EU is changing track. And through MiCA, a proposal for a regulation on markets in crypto assets, which resembles to some extent what MiFID did, a harmonized framework is expected to emerge. The goal of this MiCA, regulation on markets in crypto assets, is to establish a regulatory framework and common supervisory architecture to both the issuers and providers of crypto asset services. I have to say private crypto asset services. The digital euro is the task of the ECB. And however, MiCA explicitly says it will not apply to the monetary authorities, such as the ECB, but also other central banks outside the Eurozone, such as the Riksbank, nor will it apply to non-fungible crypto assets. So whether central banks' laws can be interpreted as providing a mandate for the central bank to issue a digital currency depends on the design choices, which I will proceed to elaborate in a few minutes. But broadly speaking, the provisions authorizing a central bank to issue notes can provide a legal basis for token-based CBDCs. Emilius referred to this paper in which I contributed to the IMF study. And the provisions in central bank laws that facilitate the opening of accounts at the central bank can actually serve as a legal basis regarding account-based CBDCs. Before I move on to some of the design features of CBDCs, let me clarify a few concepts. So what is central bank money today? So central bank money today consists of banknotes or notes and reserves. So the banknotes or the cash in circulation together with the coins, which is a minimum part of the cash in circulation, and reserves, the central bank reserves, which are only available to the commercial banks that keep deposits at the central bank. So central bank money consists of banknotes and reserves. These two are the most liquid, risk-free assets in the economy. From an accounting perspective, central bank money has been traditionally accounted for as a liability in the central bank balance sheet. I have written a paper together with Jason Allen, Simon Gleason, Saúl Omarova, Michael Kunhoff, and Will Bateman, in which we contend that notwithstanding this accounting treatment, central bank money is more akin to equity of the nation or social equity and not debt. And this, of course, has also repercussions from the perspective of CBDC. So this is central bank money, but money is also commercial bank money, as Lady Wolffe mentioned at the beginning. Bank deposits create money. Bank deposits are created through bank loans, as my colleague Michael Kunhoff rightly emphasizes. Banks create new money when they lend, and therefore commercial bank money is created when banks make loans to households and companies. And commercial bank money as a means of payment and store of value, relying on the unit of account of the jurisdiction where banks operate, in this case, in this country, the sterling pound, is the major part of the money in the hands of the public. Indeed, economists refer to M1, and around 97% of the money in the hands of the public comprises commercial bank deposits, and only 3% is cash. I have to say here, because this is part of my presentation, that because commercial banks create money, they're private creators of money, they are heavily regulated or more regulated than other financial institutions. Indeed, the monetary and payment rationale is, together with the prudential rationale, key to the understanding of why banks are more heavily regulated than other financial institutions. Banks, indeed, have a key role in two public goods: money and the payment system. and this justifies regulation. So money is central bank money and commercial bank money. So in this respect, where will central bank digital currencies come? Central bank digital currencies will be a new form of central bank money. It's important perhaps at this point to recall the functions of money and the concept of manniness. Manniness is the product of three traditional functions, that of being medium of exchange, store of value, and unit of account. And a central bank money fulfills these three functions. So sometimes in jurisdictions where there is hyperinflation, central bank money loses the function of being a store of value. Whether legal tender is an essential attribute of currency is debated in the literature. In the IMF paper that Emilios was referring to, which is co-authored by Wolffe, Bosu, and other members of the staff of the legal department of the IMF and the Monetary and Exchange Affairs Department, they suggest that yes, that legal tender is an essential attribute of currency. Simon Gleason, the author of the Legal Concept of Money, suggests it is not. I am of the opinion that legal tender is an essential feature of currency. Nobel laureate Robert Mandel, bearing in mind the functions of money, argued that monetary sovereignty comprises the right to determine what constitutes the unit of account, the right to determine the means of payment, legal tender for the discharge of debt, and the right to produce money. And according to Mandel, as an economist, he thought the most important dimension of this monetary sovereignty is the right of a state to declare what counts as legal tender for the discharge of debt. What is legal tender status? Is the power to validly and definitely distinguish monetary obligations, which must be accepted by the state as well as by all private individuals as final settlements. Whether it is legally possible to attribute legal tender status to a currency actually depends on the relevant enabling provisions. The EU treaty is clear in this regard in Article 128 of the Treaty for the Functioning of the European Union, which explicitly says that the European Central Bank shall have the exclusive right to authorize the issue of Eurobank notes within the Union, and it further adds, only such notes will have the status of legal tender within the Union. It is important at this point to note that a digital euro will be in the form of a digital equivalent and complement to tangible cash for the ECB. Interestingly, before I continue to other concepts, let me say one more word about legal tender, and that has to do with the fact that the recent adoption of Bitcoin in El Salvador as legal tender raises issues about the confluence between the private and the public domain in the provision of money. The fact that El Salvador adopted Bitcoin, a private currency, as legal tender provides a new gloss to this concept of legal tender, even though cryptoization, so the adoption of a cryptocurrency like Bitcoin as legal tender in El Salvador, is unlikely to beat dollarization or the reliance on the dollar that many emerging economies have, and is one of the reasons why sometimes they want to move towards a digital currency to avoid the excessive dominance that sometimes in trade between those countries and the US the dollar has. So let me now move, having explained what money is at the moment, central bank money, which are the bank notes and reserves plus the commercial bank money. So CBDCs would be a new form of central bank money. There is no commonly accepted definition of the term CBDC. The Committee on Payments and Market Infrastructure of the BIS, which represents the opinion of over 20 central banks worldwide, states that CBDC is envisioned by most to be a new form of central bank money. That is a central bank liability denominated in an existing unit of account, which serves both as a medium of exchange and a store of value. What makes this a new form of money is that CBDC is issued digitally by the central bank and intended to serve as legal tender. I have to mention here the research by a colleague of mine, Saúl Omarova, in an excellent paper called the People's Ledger, How to Democratize Money and Finance. She suggests that central bank accounts, which she calls Fed accounts, thinking of course about the US Federal Reserve System, can replace rather than coexist with private bank deposits. I have to say that others have advocated that private banks should not have the power to create money before. Just to name a few: Irving Fisher, Lawrence Kolikov, Andrew Jackson, Ben Dyson, and in our country, Martin Wolffe has sometimes also advocated that commercial banks should be stripped of the power to make money. In a nutshell, their argument is that banks are a source of instability and that the provision of money, which is a function of the state, should be separated from the provision of credit and finance, which is a function of the private sector. Saul's originality is that her proposal takes into account the opportunities that digitalization offers for central bank digital currencies. On the liability side of her proposed ledger, which she calls the People's Ledger, she envisions the complete migration of demand deposit accounts to the Fed's balance sheet, to the balance sheet of the US Federal Reserve System. And she explores the full range of new, more direct and flexible monetary policy instruments which will be enabled by this shift. On the asset side, she advocates a comprehensive qualitative restructuring of the Fed's investment portfolio, which she claims would maximize its capacity to channel credit to productive issues in the nation's economy. We can see that the opportunities for designs of CBDCs are very rich and have many angles. But before I get into the different design features of CBDCs, let me contemplate the other two in the trichotomy, the unbacked cryptocurrencies and stablecoins. So Bitcoin is an unbacked and decentralized cryptocurrency, as most of us in this lecture today know, whereby transactions are verified by network nodes through cryptography and recorded in a decentralized distributed ledger called blockchain. The electronic transfer between users takes place without the involvement of intermediaries and without the oversight of central banks and governments. A blockchain allows users to confirm transactions without the need of a central clearing authority. Bitcoin has provided a scripted language that can be used to design simple smart contracts, and more expressive platforms such as Ethereum allow for greater flexibility, which has enabled the development of decentralized finance. That will be the subject of the research of Emilius. So moving from specific Bitcoin to other crypto assets, that's the generic denomination, sometimes also referred as cryptocurrencies. I prefer the term crypto assets, for a wide range of highly heterogeneous assets whose common trait is the fact that they are a digital representation of value or a set of contractual rights. They rely on DLT, distributed ledger technology, for their transmission and storage. And unlike central bank digital currencies, they are not backed by a central bank or any other authorities. A large part, also has to say, of the crypto activity takes place outside the regulated environment. And indeed, at its origins and roots, the crypto government is libertarian, some would say anti-government. And of course, I have to say, before I move on to stable coins, a very negative feature of Bitcoin is the very significant amount of energy it consumes. Stable coins or digital tokens or crypto assets whose value is pegged, is backed by a more conventional financial asset, which is typically a fiat currency, but together with these fiat collateralized stable coins, there are also algorithmic crypto collateralized stable coins, which are algorithmically controlled, and there are also commodity collateralized stable coins. So the key definition and the key difference between Bitcoin and other cryptocurrencies, which are unbacked and stable coins, is this backing by other real or virtual assets as a form of collateral, which is designed to maintain a stable value relative to fiat currency or the asset whose backing is providing that stability in their value. If the use of the stable coins reaches systemic scale, we talk about systemic stable coins. global stablecoins or those operating across multiple jurisdictions. Those stablecoins such as Tether and USD coin are designed to reduce volatility. In my opinion, the term stablecoin is a misnomer. Perhaps we should remember the words that Humpty Dumpty told Alice in the famous Through the Looking Glass. He said, when I use a word, it means just what I choose it to mean, neither more nor less. I feel this when I read about the stablecoins. So what are the design features of CBDC? Technology allows for a variety of design features for CBDCs. In an article which I wrote with Sarah Diez, we examine some of these basic design features. A first basic design features addresses the way in which digital money is stored, and therefore also the payment authentication. This is the traditional difference between account-based central bank digital currencies and token-based digital currencies. Digital money can be transferred from one person or user to another by the transfer of a claim on an account held by the central bank. Such transactions are called account-based and function similar to the transfer of money from private bank deposits from one customer to another, except that the central bank is taking the place of the private bank. The ownership in an account-based CBDC is tied to an identity of the relevant account holder. Only the identified account holder is entitled to the claim, and therefore transactions have to be authorized by identification. While having balances in the books of central banks is indeed as old as central banking, the central banks have always been in the role of, as bankers' bank, holding reserves at the center. The alternative transaction, the so-called token-based transaction mechanism, is much more novel and functions by transferring a token between two wallets, two electronic wallets. Token-based CBDCs has some resemblances to cash, which could also be qualified as a form of non-digital token-based central bank money, while reserves will be account-based central bank money. In both cases, the claim is not enshrined on an account, but in a digital, in the case of cash, in the case of CBDC, or physical token, in the case of cash. And whoever owns the token, that is the physical banknote, or respectively knows the digital signature, is authorized to claim for the transaction. A second fundamental design feature is the decision about the group of designated users of CBDC, retail and wholesale CBDC. Retail CBDC is a digital currency issued by the central bank for the general public. That is for domestic payments by households and also for small or medium-sized enterprises. It is a one-to-one relationship with existing cash and bank deposits. So central banks see retail CBDCs as a complement to the existing cash. Retail CBDCs can follow an indirect model or a direct model. Under an indirect or hybrid model, the central bank maintains a central ledger which records the CBDC balances and processes payments, but banks manage customer account services. Under a direct model, on the other hand, customer accounts and account management services are all handled by the central bank. Under the Bank of England model that is being discussed, the Bank of England would not provide direct central bank digital currency accounts to customers. Instead, it would operate the infrastructure to enable CBDC payments, while commercial banks would connect to this infrastructure to provide wallets and related services. This, incidentally, was one of the criticisms that was made in the House of Lords report when they said it was a solution in search of a problem. Since there is already a payment system, what would this add to the existing system. But anyway, moving from retail to wholesale, wholesale central bank digital currencies are designed to facilitate payments between financial institutions. So rather than be offered to the general public, these wholesale CBDCs are similar to the reserves that banks currently hold at the central bank, though these wholesale CBDCs are likely to include more than banks and extend to the balances held at the central bank by other financial institutions, not only commercial banks. So for instance, mutual funds, pension funds, and insurance companies. So while wholesale CBDCs, if adopted, will be characterized by high amounts and few transactions, retail CBDCs, those offered to the general public, will be characterized by low amounts and numerous transactions. This design issue can also raise, depending on what model is finally adopted, issues of concentration of power in the hands of central banks. At a time in which central bank mandates have become extended, some would argue overextended in response to the global financial crisis, as well as COVID-19, through programs, for instance, of quantitative easing. The House of Lords last year also had an inquiry on the quantitative easing program of the Bank of England and published a report on quantitative easing, a dangerous addiction, ? I was actually privileged to act as a specialist advisor to the House of Lords in that particular inquiry. And one of the issues that was discussed is the overextension of central bank mandates. This actually coincides with calls for central banks to add a green climate change to their mandates. The fact that the Bank of England has received a green mandate, as well as the Prudential Regulation Authority, Monetary Policy Committee, Financial Policy Committee, Prudential Regulation Authority, and the Financial Conduct Authority, they all now have a green mandate. In that, the UK is at the forefront of developments of a green mandate, a green agenda for the central bank and the supervisory agencies. So the future is digital, but also green and sustainable. And there is a limit to how much the central bank can do. That perhaps we should not take it as being less optimistic about the advent of central bank digital currencies, but rather as a note of caution that any extension in the powers of central banks need to be accompanied by commensurate measures of accountability. And one of those forms of accountability, which is fundamental in a democracy, is parliamentary scrutiny. Anyway, moving from these issues of design that can raise the potential for excessive concentration of power, back to actual design of CBDCs, the choice by a central bank of how to design a new digital currency, as I said before, 90 central banks are looking into it, and those include the European Central Bank, the Bank of England, and the US Federal Reserve System, as well as Japan, Singapore Monetary Authority, South Korea, and many other major jurisdictions around the world. But the choice by a central bank on how to design a new digital currency is not only dependent on policy preferences, it also, and it raises many technological issues and many economic issues. It's also a question for lawyers. Most central bank laws give the central bank the power to issue notes. Traditionally, this has been a monopoly of note issue, and that has included specific provisions regarding the production, circulation, and withdrawal of banknotes and coins. So this is one piece of powers that are usually reflected in the law of the central banks. Most central bank laws also give the central bank the authority to open accounts for their counterparties, which, as I mentioned before, so far has been exclusively commercial banks. They're the only ones that hold reserves at the central bank, in this country, the Bank of England. And this legal basis to hold reserves is also important if one considers account-based CBDCs. In the Eurozone, for example, taking into account these legal powers, the ECB, in its October 2020 report on a digital euro, came to the conclusion that this Article 128 of the Treaty for the Functioning of the European Union which I mentioned before, and which authorizes the ECB to issue bank notes in the euro area as exclusive legal tender in the Eurozone. This article could serve as a legal basis to issue digital euros with the status of legal tender. But there are other treaty provisions of relevance depending on the final design that the ECB adopts, and obviously the legislation that will be adopted following the legislative process in the European Union. Other treaty provisions of relevance are Article 17 of the Statute of the European System of Central Banks, which foresees that the ECB may open accounts for credit institutions, public entities, and other market participants, and accept assets as collateral, and Article 127.2 of the Treaty for the Functioning of the European Union, which gives the ECB the task to promote the smooth operation of the payment system. So one last design issue which I wanted to discuss, and which is rather is a difference between the existing central bank money and the potential adoption in this country and other jurisdictions of CBDC, is the possibility to design CBDCs as interest-bearing. Banknotes and coins have so far been always issued at par, presenting the face value printed on the means of payment, and they are not interest-bearing. Only reserves and settlement balances are designed to carry an interest rate. A CBDC, however, could be constructed to carry an interest rate, and this could open a novel opportunity for the conduct of monetary policy. And the design options in this regard are actually manifold. It would be possible to set positive or negative interest rate. The way that the economy and central banks are moving at the moment, they will be positive, at a fixed rate or a variable rate. The rate could be linked to other policy rates or could be set independently below or above other rates in order to set incentives to invest or disinvest in CBDC. And remuneration could also be tiered depending on the different categories of investment situations. And there is still some debate whether only account-based CBDCs can be technically constructed as interest-bearing, or whether this option could also be available for this other type of CBDCs, the token-based CBDCs. While the Committee on Payment and Market Infrastructure seems to be of the view that both forms of CBDC can carry interest, the IMF paper that Emilius was referring to in his kind introduction argues that only account-based CBDCs would be suitable for remuneration. Having discussed the design features briefly, there are others, the key ones of CBDCs. Let me now move to the advantages and drawbacks of CBDCs. The advantages of CBDCs are convenience, 1, also faster, cheaper, and more efficient payment systems, 2, 3, possibility of greater financial inclusion, though some of the advantages could also be drawbacks. For instance, old people may feel excluded with new technologies that they do not understand. But typically, financial inclusion is considered an advantage of CBDC, as well as competition and perceived safety. The issue of competition in the provision of currency is resonant of the theories of Hayek. And it has, as I said at the beginning, the old debate has acquired a new light with the virtual currencies. The main drawbacks, or sometimes fears, not necessarily a drawback, fears of CBDCs, and again, this depends very much on their design. So depending if it is account-based, retail, interest-bearing, or if it is wholesale, token, and non-interest-bearing, depending on these design features, which I briefly discussed, there are financial and non-financial fears or drawbacks. The non-financial fears, which are well known, relate to privacy and a state surveillance of people's spending choices. We don't want to have a big brother, 1984, over us. And this potential undue concentration of information is a concern. And also generally, as I mentioned before, concerns about increasing the power of central banks at a time in which they are also given other powers. Another fear is the ability to control cyber risks. and the creation of a centralized point of failure, potential hacking, that could be a target for a hostile nation state or criminal actors. Obviously, the avoidance of the use of digital money for money laundering and financing terrorism remains a key consideration in the road to mainstream digital money, both the public alternatives and the private alternatives. So those are the kind of non-financial fears. What are the financial fears that are typically mentioned? One is that they can cause bank disintermediation and credit constraints. Again, this depends on the design features. That they can continue to balloon already inflated central bank balance sheets, increase volatility, and generally risks to both monetary and financial stability. Why and how? Well, the extent to which CBDCs can alter the patterns of access to credit and payment intermediation offered by the formal regulated commercial banking sector, which in turn could affect the profitability of the commercial banks, as well as the conduct of monetary policy, since, as I just mentioned before, conventional instruments of monetary policy operate upon the reserves of the commercial banks. If every citizen can open an account with the central bank and make transfers of central bank money via an electronic wallet and a token directly with each other without intermediaries, commercial banks could lose their role as gateways to high-power money, a hypothetical scenario that is referred as this potential disintermediation of banks. Again, this depends on the design of CBDC, and it also depends on the potentially unlimited access to central bank money. It could also run into problems if financial markets experience turbulence. We all know about bank runs with Northern Rock and other cases during the global financial crisis. And these runs where anxiety drove consumers to hoard cash, fueling liquidity crisis might potentially look even worse with a CBDC. Central bankers and researchers have warned, given the potential scale and speed of very destabilizing as they forecast digital runs. But even during normal times, disintermediation could have negative side effects for financial stability and monetary policy. If commercial banks are faced with the central bank as a competitor providing retail CBDC, their business vis-a-vis private retail customers might decline, shifting their focus towards the wholesale side. And in order to be able to compete with CBDCs issued by the central bank, commercial banks might also tend to increase deposit interest rate to keep their customers. These developments might in turn increase cost for credit access to consumers with negative implications on economic growth. So these are all fears. There are also transition risks. Always when we move from one system to the other, there are always transition risks, including disruption and uncertainty. I have to say that in my opinion, those risks tend to be overblown and actually can be remedied with adequate planning and sequencing. Perhaps a word of caution. Innovation always brings controversy. When the euro-dollar market rose to prominence in the 1970s, in part because of the restrictions of a regulation in the US, Regulation Q, which capped the amount of interest that could be offered in the US, the issue of the location of the banks was important from the perspective of the regulation and supervision. But in the end, the concerns about the euro dollar, that is the dollars, deposit liabilities denominated in dollars in banks outside the United States was, in my opinion, a bit overblown. Let me say, before I move into the international arena, a few words about sovereignty. So monetary sovereignty is a particular attribute of the state under international law. And the trichotomy that I have discussed in my presentation of cryptocurrencies, stablecoins, and CBDCs is clearly challenging established notions of money and monetary sovereignty. Indeed, arguably, the rise of cryptocurrencies and stablecoins is a great threat to monetary sovereignty today, and the monetary authorities are responding to this by developing CBDCs. Talking about sovereignty and the digital space, cyber sovereignty adds a third border, a virtual dimension to the classical perimeter problems that have characterized financial regulation, namely the borders between regulated and unregulated entities and the territorial borders between national jurisdiction. This third border between the real world and cyberspace, which is a domain of human interaction facilitated and conditioned by digital communication system, adds obviously a new dimension. I have actually explored this issue in an article I wrote with Jason Allen on border problems. Of course, if one looks at innovation and monetary sovereignty, it's important to reflect that to some extent, digital money has been with us for some time, since bank deposits are accounted for and transferred using online systems. At this point, perhaps we can recall that in 2009, Paul Volcker, the former chairman of the Fed, criticizing a banking industry that had taken the system, the financial system, to the brink of disaster, said that the ATM had been the only useful financial innovation in banking for the last 20 years, so the years prior to 2007, 2009. But with digitalization reaching the source of central banking, we're talking about a new potential revolution. And this competition between public virtual currencies, CBDCs, and private virtual currencies such as Bitcoin, unbacked, and stable coins backed, adds a new dimension to the old debate between the state theory of money and societal theories of money, or market theories of money. As we know, the societal theories of money argue that it is not the state, but ultimate society, custom, and usage that decide what money is. Perhaps let me quote that in a report on the digital euro written by two economists, Brunnermeier and Landau, for the European Parliament and published now in 2022, they again make a case for the state theory of money. And they say, and here I quote a paragraph from the summary of their study, a new type of money is emerging based on virtual units of value moving on the internet. It can be broadly thought as digital cash. It can be stored on a mobile device or a computer. It can be instantly transferred, just like sending an email. It can be used to pay from person to person, peer to peer, irrespective of distances and borders. And then they say the central policy question raised by digitalization is the role of public money, the properties of being universally accepted and widely accessible, which is the anchor of the monetary system and which has provided the unit of account for all transactions and operations in the economy. Let me now move to the third and final part of my presentation, which is the international dimension of digital money and the monetary system that may emerge, particularly considering the war of aggression on Ukraine by Russia at the moment. Mark Carney, former governor of the Bank of England, in a speech in 2019, discussed the opportunity of establishing a global digital currency that he called a synthetic hegemonic currency, SHC, which would be anchored by a basket of fiat currencies. It reminds at the global level what Facebook wanted to do with Libra, then D, and then abandoned, anchored by a basket of fiat currencies. And Mark Carney wondered whether such a global currency, digital global currency, could be best provided by the public sector, not by the private sector. At that time, that's when Facebook had come up with the proposals for Libra, through a network of central bank digital currencies. He also said that this could help diminish the influence of the US dollar in global trade. The idea of a global currency is not new. It actually goes back to John Maynard Keynes' Bancorp, when John Maynard Keynes, together with Harry Dexter White, put together the proposals that led to the establishment of the Bretton Woods institutions, particularly the International Monetary Fund. Keynes had suggested that Bancorp was the name of the unit of account, the global money of his proposed International Clearing Union. Bancorp was never established, but In 1969, through the first amendment to the IMF Articles of Agreement, the SDR, the special drawing right, was created as the principal reserve asset of the international monetary system. And the former IMF managing director, Madame Lagarde, raised, when she was still at the IMF, now she's at the ECB, the possibility of launching a digital version of the SDR. A virtual SDR, harden the SDR to make it properly as a global currency, could facilitate its use, created a global cryptocurrency that could circulate along national or regional cryptocurrencies. The dollar's influence on global financial conditions could similarly decline if a financial architecture developed around a systemic hegemonic currency or another global currency were to arise. But back to the present. The present is that we do not have a global cryptocurrency. The SDR, though it is a reserve asset, it doesn't have all the characteristics of money. It is indeed the unit of account for all the operations that the IMF conducts with other central banks, as well as lending when it does to countries that are in balance of payment needs. All the standby arrangements are always denominated in SDRs. But the SDR is not a commonly accepted means of exchange or payment. So it doesn't have that key feature of that money is in order to have that moneyness. Remember, medium of exchange, unit of account, store of value. So the present is that the US dollar acts as a global currency. The US dollar, of course, is issued by the US monetary authorities and, however, is the reserve currency, the anchor in international monetary relationships. The US dollar is not backed by gold or any other commodity. The system that emerged after World War II, the Bretton Woods regime that Harry Dexter White and John Maynard Keynes have helped devise and was approved at the United Nations Conference in 1994. This Bretton Woods regime that started when the IMF started operations in Washington in 1946 had relied upon a two-tier system of convertibility based upon gold and the fixed US dollar value of gold. That is a system in which the key currency, the US dollar, would be convertible into gold, and the other currencies participating in the system, in the Bretton Woods system, into the key currency, which is the US dollar, or which was the US dollar. The system was abandoned de facto in 1973. I will not go into that now, there is no time, and the jure in 1978 with the Second Amendment to the Articles of Agreement of the IMF. Incidentally, prior to World War I, there was no international legal obligation required to adhere to the gold standard, and the gold standard collapsed almost overnight at the start of World War I. But Bretton Woods was this two-tier system of convertibility. So the dollar has reigned alone supreme since the abandonment of the Bretton Woods regime, notwithstanding the role of the euro, which has been very much the same in the international arena since it was established in 1999, and notwithstanding the increasing role of the renminbi. However, sanctions, the weaponization of finance, the use of finance as a weapon, particularly on central bank reserves, will dilute the dominance of the US dollar and will result in further diversification of the central bank's reserve assets and a more fragmented international monetary system. China has developed a cross-border interbank payment system, CIPS, as an alternative to SWIFT, and is working hard to develop the renminbi into an alternative to the US dollar, though many people are skeptical that that will happen anytime soon. But in this regard, the arrival of the BCEP, the digital version of the renminbi, is of course a step in the direction of increased international use. And indeed, China is already promoting the use of BCEP in Africa. A parallel monetary and payment system outside SWIFT, as we all know, SWIFT has been in the news recently in the context of the sanctions imposed on Russia following the war of aggression of Ukraine. And again, just to state what most in this audience already know, most international payments are settled through SWIFT, which was founded in 1973 as an international cooperative and your Belgian law, and basically international payments via SWIFT enjoy a de facto global monopoly. But the recent sanctions will likely incentivize some countries to make their payments outside SWIFT. Indeed, after the sanctions imposed following the annexation of Crimea, Russia started working on an alternative to SWIFT called CSPFS, and several countries were invited to join. But a parallel monetary and payment system outside SWIFT is already emerging. And indeed, as I just mentioned with regard to China, the DCEP offers an alternative which can be attractive for trade between China and some trading partners. And it is also possible that sanctions will encourage the emergence of a small currency bloc based on trading between countries such as Russia, China, Saudi Arabia, or India. Will we see a return to gold backing or commodities backing? That's a question. It does look that very recently the Russian ruble, the Russian central bank has announced that the Russian ruble will be backed by gold or a basket of commodities. This announcement, which has surprised the financial markets by the Russian central bank, of a fixed price for buying gold with rubles, with a price of rubles 5,000 for a gram of gold, is the first time that the nation's currency is expressed in gold parity since Switzerland stopped doing so in 1999. But whether or not this practice will go beyond the current insistence or attempt on the Russian central bank to perhaps recover some credibility for the ruble, making it more desirable in the forex market, remains to be seen. What is for sure is that after the war is over, the monetary system will never be the same again. There will be changes to it. By way of conclusion, let me just say that money is a public good, and as such, it requires the public ordering of the monetary and payment system. In that public ordering of the economy, where the safeguard of confidence is key, central banks have traditionally played a key role as lender of last resort, as monetary authorities, and in the discharge of other responsibilities in the pursuit of the goals of monetary and financial stability. Charles Goodhart explained in his book, The Evolution of Central Banks, how competing banks had a natural tendency to centralize reserves, and how this competition and centralization of reserves led to the emergence of a central bank as a non-competitive, non-profit maximizing institution, which handles the reserves of the commercial banks and lends to the commercial banks in time of distress. The role of a clearing house, which was at the origins of central banking, may arguably play a role again in the fintech universe of private digital currencies. Indeed, one can already observe a certain gravitation to some center in the concept of stable coins, since they gravitate around fiat currency and safe assets. But central banks are technocratic agencies that receive delegated powers by the government. And my final word is this word of caution, which I have already expressed, which is that in a democratic society, accountability and legitimacy are of the essence. That's why any expansion of central bank powers in the digital arena or in the area of climate change and sustainability must be accompanied by commensurate measures of accountability. Parliament's role in the introduction of CBDCs, stable coins, and other crypto assets is of fundamental importance in a democratic system. Indeed, in that ordering of money as a public good, parliaments, treasuries, or other regulatory agencies, including, of course, central banks, have a key role. Money remains a public good, and global money, as also Martin Wolffe wrote in a column in the FT the other day, is a global public good. Thank you very much for listening. Thank you very much again, Lady Wolffe, for chairing. Thank you very much Emilios and Parker Hood and the University of Edinburgh for inviting me to address you all in this very distinguished FinTech lecture, of which this year is the 4th annual lecture. Thanks.
Well, Professor Lastra, Thank you very much indeed. If we were in person, I think there would be resounding and sustained applause for what has been a fascinating insight, not just to cryptocurrency, but bringing to bear the perspective and expertise that you have, looking at it from the point of view of the state, considering whether or not to step into the kind of cryptocurrency sphere.